Well, hello. Welcome to our panel, Investment Options for Your Independent Future. I'm Portia Sabin. I run the independent record label Kill Rock Stars, and I'm the host of the music business podcast, The Future of What. So today we're going to record this panel for The Future of What, so everybody should yell and scream, make lots of noise. That was a joke. Yeah. Anyway, let me introduce my fabulous panelists. First, we have Jason Peterson from GoDigital Media Group. We have Nari Matsuura from Massarsky Consulting, and Matthew Carvajal from JP Morgan, which you may be familiar with, may have heard of in the past. You may have heard of. So I'm going to go down the line first, and I'd like everybody to introduce themselves and tell you guys what they do.
My name is Jason Peterson again. I run GoDigital. We are a technology-enabled intellectual property rights management business. We operate a portfolio of companies across the media landscape, several of which are in the music space, including a label and a distributor named Sync Music, that's CINQ Music, and a multi-platform network very similar to Vivo or MTV called Vita Primo, but specifically targeted at Hispanic millennials.
My name is Nari Matsuura, and I'm a partner at Massarsky Consulting, and we do valuations for record labels and independent music publishers, whether it's for their financing needs or their fiduciary requirements for banks, also for sellers and borrowers all across the spectrum. We've looked at every single conceivable format, genre, life cycle, so looking forward to talking about the valuation process as well.
Hello, everyone. Can you guys hear me? Yeah. My name is Matthew Carvajal. I'm a vice president within JP Morgan's Entertainment Industries Group. I focus on music finance, television finance, and film finance. Focused, or generally speaking, we deal with anything from the smaller scale independents all the way up to the larger conglomerates, both in the music and in the film and television space. The way that I put it is, our group is specialized on intellectual property assets, mainly lending to intellectual property assets, and I always joke around that we're very good at understanding the long-term value of cash flows, and not necessarily, we are very well in tune to lending to businesses with a loss, so that's why I probably fit in very well here, but we understand just long-term catalog value.
So if you're an independent label owner like me, you did not go to business school, and you did not come at this job with the idea of growing your company into a multi-million-dollar conglomerate, which doesn't mean you can't do that, and perhaps you should. But I think the thing that we're trying to get out of this panel today is sort of what are the steps that you would take as an independent label to grow your company using the investment stuff that's out there. So I just recently learned that there are these two things called debt and equity, and these are two different ways of financing your company. So I wanted to get started by having somebody, maybe Jason, start talking about the difference between debt and equity financing.
Sure. So generally speaking, debt is when somebody loans you money and you have to pay back that money with interest. Equity is when somebody essentially buys into your business looking towards participating in the profits of the business. And every market has a life cycle, every company has a life cycle. You need different types of partners, both debt and equity, and within debt and equity, different types of partners at different points in your life cycle.
This is a general question for everybody. When would you tell an indie label to pursue an investment opportunity? Like, at what point in the life of an indie label? Because there are labels like mine that are 26 years old. There's labels that are 6 months old, but they're doing really well. They're in, let's say, EDM or hip hop, and they've got a couple runaway hits. Like, when would you tell people to start looking into this?
Maybe I can tee that up for the two of you. So,
Sure.
As a brand new company, you'll have no history, probably no asset base. You're going to have to work with an equity investor. It's analogous to maybe in the technology space, right? If you have just an idea or maybe a prototype product, you're going to need to find a venture capitalist or an angel investor who's going to do a Series Seed or a Series A with you because you have not proven a validated business model. You have no traction in the market yet. Once you have traction in the market, you maybe have customers, you maybe have an asset base, now your options open up. You can work with a lender like JP Morgan or anybody else who will loan money against your asset base, against your receivables. They'll want to know what your asset's worth, so they're going to want you to work with an appraiser. And maybe Nari and Matt can talk a little bit more about that.
Sure. So from the beginning standpoints, I think that you're always going to be sitting within some kind of an equity financing round, at least in the very beginning stages. I think just from a lending standpoint, in order to really get to the size and scale of bank financing, you're going to want to get some kind of a decent sized catalog that we can margin off of. The way that bank lending traditionally works is based off of usually an EBITDA. There's really a few ways that we lend.
Can you define EBITDA for the audience?
Yeah. And also, can you pull your mic a little closer towards you?
No problem. So we traditionally leverage on two separate multiples. One is just call it a multiple based on your income statement, your net publisher share. That's one of the multiples that we lend against. And then the other one that we lend against is a catalog value. So once you've actually accumulated a decent size catalog that's diversified, that has known cash flows, that is expected to generate cash flows in the future, that's the point in time when you can really get a bank to come in and really specifically lend against that asset class. In the very beginning, while you're developing and growing your business and acquiring assets, you're likely going to need a pure equity. And the reason is just as senior lenders, we traditionally are less risk adverse. We have a known.
You mean you're more risk averse?
Sorry, we are way more risk adverse. Yeah, I misspoke. We will always be the first money out, right? If you borrow $20, $30, $40 million from a lending syndicate, the first losses will always go to the equity, and we will always look for some kind of a cushion. But at the same time, our returns are known, and our debt structures usually cost anywhere from LIBOR. They're always LIBOR based, but LIBOR plus 250 to 350. So sub 4% cost of capital.
And of course, they're going to loan money against what the assets are worth or expected to produce in the future, which is what you might opine on.
So to that point, in terms of building up your catalog so that you have an expected cash flow that you think will be generated in the future, which is why banks will come in later in the process as opposed to initially. So we will look at least 3 to 5 years of income statements. And what we do is, we look for those factors that make a catalog less risky. So are there stable cash flows? Are there, what kind of a catalog is it? Is it a golden oldies catalog? Is it a standard evergreen where you have systematic earnings year over year that are growing with the industry? Or is this something that is more hit-driven where there are huge peaks, but there are also rapid declines that are there very early in the life cycle? So then the question there is, how far and when will they fall, and at what point will they reach stable state? Or are you a catalog that's diversified and has a little bit of both? So what we do is we look at the top titles that are generating, say, 80%. You can look at it as a rough 80-20 rule, 80% of the earnings, and we'll look at them literally title by title, income stream or income type by income type, and see how these income types are trending. And look at the sales, the airplay, what have you, all the different factors, the number of streams, and we'll build out the future value of these separate titles.
So what I'm hearing you say is that basically you need to have been around for like 2 to 5 years in order to possibly get, let's say, equity funding. Is that
actually,
true?
I think what Matt was saying was that you have to start with equity. Somebody's got to invest in the business initially. It's usually
Right.
either you, friends and family, angel investors. Maybe you'll get some professional money if you have a big vision.
You're always going to have to start with something.
I would like to
Right.
note also, though, that aside from the sort of traditional music bank finance, where the bank is going to loan a company like mine money, and Massarsky and Associates might do the appraisal to figure out what the assets are worth that the bank's loaning against. Aside from that, as a smaller company, a newer company, you can get an SBA loan here in the U.S., which not all banks do, but a lot of banks do. They'll loan to much newer companies, much higher loan-to-value ratios, which we'll talk about in a minute. You can also get personal loans from the bank. In the early days, the bank will look mostly to the personal credit of the business owner. In the later days, they'll look to the business itself and may not require any personal guarantees from the owner. But if you're just starting out, I highly recommend you look at SBA finance and other sort of personal.
What's that stand for?
Small business
Association
administration.
Or
yeah.
administration, yeah.
And they have a website that goes through all the different programs they have. They'll loan up to $5 million under a program called 7A. And that's primarily based on forecasts. Most banks loan money based on the historical performance of a business. Music finance is a little bit of a hybrid, but just traditionally, in most industries, banks loan on historical performance. The SBA, which is a government entity, will insure the bank against losses up to 90%. Therefore, the bank is willing to take more of a risk on the borrower, and they'll loan based on a business plan, essentially.
Talk for a second about what you just said about having a vision. So what is it, if you're still in the early days of your business, let's say you got your SBA loan, let's say you're, moving forward, what is it that would attract equity investment, to a business? Is it some sort of like, I signed this kid when he was 18 and now he's blowing up the charts, but he's our only big artist. And then we've got 3 other artists that are not as.
I think the answer is it depends. If it's a professional investor, first and foremost, they're going to want to see you're in a large and fast-growing market. Secondly, they're going to, depending on where they are in your life cycle, right? Again, in traditional equity parlance, you're going to go through a series seed. Someone's going to bet on you when you have an idea. And you might put in some of your own money and go to friends and family and say, hey, let's raise $100,000, $500,000, whatever the number is, right? Then you might come to market with a product. In our case, right, the music business, it might be an artist. It might be a record. If you have traction, then you might get some professional investors involved. You might call that your Series A. And so, I lost the question. It just depends, though.
Just depends on.
It just depends. From a vision standpoint, professional investors want to know that you are in a large and fast-growing market and have a vision for a business that can be quite large, because they're going to look for something like a 30% internal rate of return. That's basically the annual return on their money, right? So
Right.
if they put in $1 million and they're in your business, professional investors are in businesses for on average 7 to 9 years, right? They got to get a lot of money out of your business.
Hmm.
And so if there's not an opportunity to scale because the market's too small or the market's decreasing, or maybe management doesn't have a vision for building a big business, that's going to be an inhibitor to raising money.
So something that has changed significantly in the music industry in the last few years is the streaming market has changed the way that we look at what we do, because for years this business was was album centric, right? It was the album is released, we try to maximize profits on that album for the first month, 2 months, whatever the cycle is. And then when the album cycle is over, we move on to the next one. And what has happened, what has really kind of out of nowhere, happily, but we didn't necessarily see this coming, is in the last few years, streaming has made it so that there isn't necessarily that end point with an album. Albums can have extremely long lives on streaming. And I personally have found that this has made a difference in the investment community, simply because I actually started getting calls from investors saying, hey, we might want to buy your catalog because you've been around for 26 years and suddenly streaming has a value. So how has it changed for you guys, especially with your company, which started in publishing?
Yeah.
Go ahead.
Well, streaming definitely has changed the profile of the catalogs that we've looked at. We're seeing jumps this past year in masters and also in mechanical income and publishing that we have not seen in prior years. overall the industry, streaming is 60% up from last year, and streaming makes up 50% of overall record company revenue. So it's definitely is changing our own growth forecasts. And I'm imagining from a lender's perspective, I mean, of course, Matt's going to have his own viewpoint, but we've just been speaking with one of the major lenders in this space, and they are trying to redefine for themselves what the meaning of a master is, like almost from a philosophical standpoint. Like, is this, it's not physical inventory anymore. You know, 75% of the revenue is all digital, so you're not talking about the same level of overhead. So what is a master? Is it more just rights management? And what does this mean in terms of EBITDA if you have so much less overhead? So
Earnings before interest, taxes, depreciation, and amortization.
exactly.
Did you guys get that? EBITDA.
And if there's so much growth, you know, when you look at it relative to publishing, which has always been very, very attractive to banks, and their loan to values are, you know, traditionally higher, but the growth is, although much more steady and there's less variability, it's just more modest at the same time. So if you're looking at records, you're starting from a smaller base just because it has fallen the level that it has, but growth is that much more possible to realize as a result.
I can tell you from a lending perspective, it's been a complete game changer. If you were to look back in history, and I mean, not even a very long history, we're talking 3 to 5 years, publishing catalogs were the core bread and butter that banks wanted to lend against, because it was a 1 to 3% growth per year, and everybody was comfortable that as long as you had a diversified catalog, we were going to get our money back. And our margin on those loans would be a 50% advance rate. So you have a $10 million catalog, a bank will traditionally lend $5 million against that publishing catalog. And on top of that, what we would lend to on those catalogs would be a future projection. We've, luckily in the music space and lending on IP assets, we're very familiar with the fact that publishing assets are long-term, 30-year cash flows that we can ascribe some kind of a value to. And we would take a look at that value over the next 10 to 30 years even, and we would assign a discount rate on those values. So a few years ago, you would sit there and we would say, from a bank perspective, that publishing assets, you're going to have a 10% or 9% discount rate on your assets. And then as a bank, we would loan LTV basis of 50%. And it was because it was...
That's loan to value.
Loan to value. And on the master side, what we would have said 5 years ago is, you know what, that's a master's catalog. There's going to be a decent amount more variability in the assets, and we don't feel the same way as we do on a publishing catalog.
Yesterday's news.
Yesterday's news, but I think relevant because banks are not as quick to adapt. So it's I think probably relevant for lending purposes. But in terms of advance rates, our advance rates have gone from 35% on that asset class up to 50%, and our discount rates, which used to be 14 to 15% on master rights, have shifted. So we, I think, as lenders have become much more aggressive on the space.
What are your current discount rates?
Anywhere, depending on the catalog, right? High sync catalogs are going to have higher discount rates. Publishing assets will still be with 1 to 2% within a master's business, but we're still sitting, you're in that 10% range is my view. Some are lower, some are a little bit higher.
So what, you know, we are all independent labels, and independent labels are traditionally extremely independent. I know that's like duh, but it's really true. We don't like to be told what to do. We like to do things ourselves, and most indies are run by people who are kind of like, I want to do it my way. So debt financing is easier in that regard, right? Because they're basically, the bank is just like, here's some money, thunk, see ya, good luck, hope you make it work. But equity financing, if someone's coming along and they're actually getting a percentage of your business, how much influence do they have in the day-to-day running of that business?
That's a great question. The answer, again, is it depends on both sides. As the loans get larger in debt, the banks have more control, so they'll put what's called covenants in your loan agreements. These are negotiated conditions on the loan contract that say, you're cool as long as your gross margin doesn't drop a certain amount, or you can use this money only for certain uses and not for others. You have certain reporting requirements, and those go up as loans get bigger. The kinds of loans that Matt makes are, I'm guessing, fully managed loans. There's one or more people who are paying attention to your business at all times. And because he's doing loans, in many cases, $100 million or over. So there's different thresholds of management and covenants depending on loan size, and they get bigger and more elaborate the bigger the loans get. On the equity side, again, it depends, but usually they're going to come in, they're going to get some preferred shares, so they're going to be first money out, and might get some board seats, so they're going to have a say in management. But if you build a business, again, everything goes back to life cycle curves. If you build a business that's at some substantial scale before you take on a partner, there are private equity firms out there who generally get involved in mature businesses, 5 million revenue or more, that take a minority position. So they might have a board seat, but there might be 3 board seats. And you
It all
control
depends
2.
at what point in time you raise your capital.
Yeah, exactly.
If you raise your capital early on, I would expect to give up a significant amount of controls. If you're a well-established business that's looking for growth equity and a little bit of a partner, I would expect that person to have a seat at the table, but not necessarily influence your votes. But there's different ways that you can do things. If you want straight common equity, which is essentially giving up ownership, expect to give a little bit more controls up. If you're looking at preferred equity, where you're going to guarantee somebody some kind of a rate of return, expect that you should maintain more controls. So there's a broad spectrum of at what point in capital, or at what point in time you raise your capital, and then also just how established the business is.
Would it be fair to say that the later you wait, the more control you'll retain?
Yeah, absolutely. I mean, even if you look at, just as maybe not the best example, but if you look at a public company, right, you're